What's up guys, it's George Neufeld. So what's your credit score? If you've had anything to do with borrowing money for a house or for a personal loan, chances are high that you've heard about credit. But the question is, what is credit and what is your credit? And in this video, we want to take out the mystery of your credit. And by giving you some real information that lenders are looking for when you go to them for financing, this way you can take charge of your credit and make sure that your credit is at its best. I have done almost 500 mortgage approvals and about 1,200 mortgage pre-approvals, so I have seen a lot of credit reports. But before we get into the rest of the video, just really quick, I want to give a reminder how much it means to us if you click the like button, hit the subscribe button, leave us a comment. It means so much to us. Thank you so much. All right, now let's get back to the video. So 4 things we want to consider when we think about your credit. The very first thing is, what is credit? Think about it this way. If a friend comes to you and wants to borrow something from you, usually in our mind, we do a somewhat credit analysis on them. Something to consider, when was the last time they asked to borrow something? Did they return it? How often do they ask to borrow something? And this is really like a mental credit check on our friend that wants to borrow something. The lender is no different. A lender wants to know how he can do a credit check on us when we want to borrow money from them. Your financial credit score is really not much different. A lender wants to know who the borrower is, how often they borrow money, what they want to use the money for, and what is their payment history like. And to do this, a lender will take a look at your credit report. So let's not confuse credit report with a credit score. The credit report is all the details that make up your credit score, and the credit score is somewhat like a summary. Well, since the lender doesn't know you personally as the borrower, they need to get to know you through a credit report. And as they look through that credit report, they will come across your credit score, which is like a summary of all the factors that impact your credit. A good credit score for me to be able to get a mortgage is around 680 and higher. Now here's an interesting fact. Did you know that most successful people know their credit score and they care deeply about what impacts their credit score? As opposed to a lot of people that have bad credit usually don't pay much attention to what impacts their credit. So first step in good credit is to know what your score is and how you can improve it. So number 2, what impacts your credit score? And there are a number of things that impact your credit score, but the most important one to be careful of is your payment history. So it's so simple to go and to make an agreement to make a payment by such and such a date in a month, but then fall short and not make the payment in time. Well, when we don't make the payment in time, let's say we agree to make a payment by the 20th, but if we don't make the payment that month, it'll go on as a missed payment. So whether it's a phone bill, whether it's a vehicle loan, whether it's a mortgage, they will report it to the credit bureau as a missed payment. And the credit bureau will then mark it on the credit report for any future lender to look at as a missed payment. So payment history has the highest impact on your credit score. And lenders really want to know if you're making your payments on time and if you're making your payments as agreed. The percentage of debt versus your available credit have a significant impact on your credit score. Let's say you have a credit card of $1,000 and you owe more than 50% on that credit card month over month. That will have a negative impact on your credit score. So it's important to remember not to have balances on our credit cards for longer periods of time, because even though it won't wreck the credit instantly, it will start to have a negative impact if we owe over 50% of a certain credit card. So the rule here is anything you owe 50% or over of your available credit will start to have a negative impact on your score. Let's say on a credit card or a line of credit, anything that has revolving credit, you should really try to have less than 50% of a balance so that, for one, you don't pay as much interest, but also your credit score does not take a negative hit. So payment history and credit utilization, or the balance of how much you borrow, are the 2 biggest factors that impact your credit score. And they combined make about 65% of the total impact on your credit. But there are a few other factors that impact your credit as well. Some other factors that impact your credit score are how often you do a hard pull, or how often you get new credit, like credit cards or loans, and the length of time that you've had that piece of credit. So if your credit has gotten lower and you want to improve it, follow these steps to improve your credit. Make sure that your payments are never late and that you always make them a few days ahead of time before they're due. And also make sure that you don't owe anything over 50% on any credit card or a line of credit. And having a zero balance will really help you boost your credit. The other factors really don't have as much impact as your payment history or your credit utilization, but it is important to remember not to do a credit check too often. All right, now that we considered what makes up your credit score, at number 3, let's talk about alternative credit. So there are some situations where I don't get a credit score back when I do an Equifax or TransUnion pull. And in those situations, we can use alternative credit. There are a few lenders that will accept this instead of a credit report. And to do this, I usually need about 12 months of bank statements showing either rent payments and insurance or rent payments and a phone bill, something like that that will show that you've been making payments for at least 12 months. And this 12-month period is really the minimum for any lender to consider credit. Even if you have a credit card, for a lender to consider that as established credit, they want to see a minimum of 1 year. And it's no different with alternative credit. When we don't get a credit score back, they want to see that you've been making either rent payments and phone bill or rent payments and insurance payment for 12 months. And to do that, I just need to show them 12 months of bank statements. And at number 4, myths about credit. So I hear some people say that in order to have a great credit score, you have to love to pay interest to banks, or you have to use credit cards so much that you pay a lot of interest and therefore have a good credit score. But the reality is the company that puts together your credit score is totally different than your credit card company. So you don't have to use your credit card all that much in order to have a good credit score. All they want to see is that the payment was made on time and that the balance wasn't that high, especially not over 50%. And your credit card company will then give a good report to the company, either Equifax or TransUnion, and therefore you will get a positive credit score. So you don't need to use your credit card constantly to build good credit. You just have to have an active card and not be late on a payment. Another myth is that if I wait longer, my credit score will go up. But the reality is that if what brought the score down keeps happening, then just waiting longer will not improve the score. We actually have to make some changes because something brought a score down. If a credit score is low, something brought it down, and we actually have to make changes in our financial habit, in our spending, and all of that in order to actually improve the score. By changing our habit, the lender will see that we're actually changing the way we want to pay them back. Therefore, if my score went down, I might have to make some changes in my payment history or in the credit card balances that I carry in order for the credit score to actually come back up. Because lenders want to look at our credit report and somewhat get a peek at our character and how likely we are going to repay the loan that we're asking to borrow from them. So in conclusion, when I ask to borrow money from a lender for any reason, lenders want to know how likely we're going to repay that loan. And similar to if a friend were to borrow something from us, we want to know what that creditworthiness of the friend is, how likely we're going to get back the product that we borrow out. The lender wants to know how likely they're going to get repayment on a loan that we borrow. And by developing good habits around these factors that impact our credit, you can make sure that you have a great credit score and lenders will actually want to borrow you money. Credit can be an amazing thing and a great tool to help you get better financial success, but credit can also be a very dangerous thing because using credit in the wrong way can dig us a deep hole that we can't hardly get out in the future. So as we build our credit score, let's keep in mind what we want to use our credit for and how we can use it to get ahead rather than dig ourselves a hole that in the future we will have a hard time getting out of. By learning to manage your credit and applying the things that we talked about in this video, you can actually take charge of your financial success and set yourself up for the future. So remember, practice good financial habits and your credit score will improve drastically. And even if your credit score isn't good right now, by applying what we talked about in this video, it will improve very quickly. Dream big and succeed. And remember guys, leave us a comment. We appreciate it so much if we see many likes on the video. Helps us so much with the YouTube algorithm to push the content out further. So remember to do that. Have a great day.